Well, greetings to all my clients. My name is Walter Measers. I'm your wealth manager, investment advisor, also your tax advisor. I'm recording actually, this is being recorded on Sunday evening. Sorry for the delay. As you guys know, I also do taxes for my clients. So I'm doing double duty tax preparation and money management for our clients. So, again, apologies for the late posting. But again, this is our weekly market recap. And right now, what you see on the screen is one day what the market did. That's February 28th, Friday, the last day of February, what the markets were doing. And we're comparing QQQ, SPY, TLT. QQQ is technology. ETF, SPY is a broad market S&P 500 ETF, and TLT is 20 and up long duration bonds. The reason I'm comparing pretty much, the stock market to the bond market is what's starting to happen is that there's a diversion happening right now. As stocks go down, as you can see, long duration bonds are actually going the opposite direction. But as the market continued to go up at the end of the day, long duration bonds were kind of flat and eventually also went up. You look at 5 days, the relationship between long duration bonds and the stock market, actually for 5 days, long duration bonds have been going up where the stock market's been going down. The question is, why are long duration bonds going up in value? Because interest rates are starting to trend down. Is that going to continue? We're waiting for the right signal to kind of get into long duration bonds. That's going to happen. I just don't know if it's in a week, in 2 weeks, or 3 months. I have no clue. We're waiting for that signal where that trend of lower interest rates is going to continue. That's where we're going to get into long duration bonds. So as you can see, it's very visual. As interest rate, as stock markets go down, really long duration bonds are going up. We look at 1 month. Again, you can see stock market is going down. Long duration bonds are going opposite. We look at 3 months. Let me go back. We look at 3 months. Same thing is happening. There's an inverse reaction as markets were kind of going up. Long duration bonds were not doing well. And then as markets started to go down, you can see towards the end of February, long duration bonds started to go back up. So if we look at 3 months, pretty much stock market is flat, actually lost money, and TLT also lost money. So it's still not time to get into long duration bonds, but it's also a time to sit on the sidelines and wait for the market to find a momentum, find a direction, and that's really what it's doing right now. Now, if we look at 6 months, again, you can see the relationship as stocks go up, long duration bonds do not do well. If we look at 5 years, long duration bonds would have been a horrible investment. Over the last 5 years, long duration bonds lost 40%, where the market, as you can see, is up pretty significantly. But what this also tells us in the 5-year period is, where's the risk? It's up here in the stock market. The market really is overpriced. It's at that topping stage 3, where there isn't that much more room where a stock market can go up. So the risk out of the bonds is pretty much has been squeezed out. Could it go down another 5%? Yes. But the probability, again, that long duration bonds are going to be a good investment. Again, at some point, interest rates will have a steady momentum of trending down. Let's take a look at another chart which gives us a better picture of what this is showing you on the screen is interest rates. And it goes back to 1994. What were interest rates doing? And we're comparing this to TLT, long duration bonds. As you can see, as interest rates come down, what are long duration bonds doing? They're going up in value. If you can see this is where COVID, the Federal Reserve was aggressively cutting interest rates, and interest rates, the bond market also was going down. The private sector, interest rates are going down. And look what happened to long duration bonds. They were a phenomenal investment where the markets were really, here in 2020, markets lost almost 40%. So the point I'm trying to make is, which is there a good probability that interest rates are going to start to head down over the next, next month, 2 months, 3 months? And I would have to say yes, the probability is there. And again, why? Well, let's look at economic indicators. This is as of February 28th. The major economic indicators are really pointing to there's a slowdown in the economy. Initial jobless claims rose by 22,000 to 242. In other words, that means 22,000 people filed for new unemployment. That's not a good sign. Anytime you start trending, as we can see, unemployment is starting to kick up. The big one is consumer confidence had a bad reading. What is that? That's where consumers are saying, hey, we're worried about the economy. We're worried about inflation. I'm worried about my job. What if I lose my job? What does that mean? People tend to pull back and not spend because they're not sure if they're going to have a job. The Texas Manufacturing Outlook Survey, this was not a very good reading. Consumer spending, still people actually down. In other words, people are spending less. Disposable personal income is up. Core PCE, that's up. Again, the fear that inflation is going to be sticky. New home sales actually dropped quite a bit, 10.5%. Durable good orders up. The GDP for the fourth quarter was 2.3%. But what I want to show you, so again, the trend is, hey, there's an economic slowdown. As one of Jeff Schneider says, the economy forgot how to grow. It's really flattening. There's not a trend upward. Actually, it's the opposite. It's trending down in the wrong direction. There's, by the Federal Reserve of Bank of Atlanta, they have what they call GDP Now. In other words, they're trying to look forward, and what they're reading, what they're saying, their latest read is that for the first quarter of 2025, their latest estimate is actually negative 1.5%. Prior to that, they were predicting 2.5% growth of GDP in the first quarter, excuse me, of 2025. Well, they've reversed that. So this is an estimate. Again, this is not hard data, but they're seeing something that there's an economic slowdown. So these are not good signs. Is there going to be recession in a month or two? I don't know. But again, the trend is in the wrong direction. So bottom line is we are sitting on the sidelines. Just like Warren Buffett, he has over $350 billion in cash. He's never done that before. He's sitting on the sidelines waiting for an opportunity to get back into the market. So if you don't know who Warren Buffett is, he's probably the greatest investor of our time. He's 93 years old. We're Berkshire Holdings. Just an amazing, amazing investor. So he's seeing something in the market that makes him uncomfortable. So again, we are sitting on the sidelines waiting for an opportunity to get back in, either in the stock market if we see momentum up, but most likely at some time we're going to get into long duration bonds. And again, as I'm showing you, interest rates at some point will have to come down. So there's going to be a great opportunity to make money even if the markets are going down. Full disclosure, this video is exclusively for my investment clients. If anybody else is watching this video, this is not investment advice. This is not intended as a solicitation to buy or sell stocks. So please do not make any changes to your portfolio. This is again an informational video talking about stock market and probabilities of which direction the market and the economy may go. Again, I don't make predictions. These are probabilities. So thank you for watching. Hopefully this was helpful. Please give me feedback. See what you think of the recordings, if they're helpful. So stay tuned for our next market recap, which will be next week. Take care. See you soon.